Welcome to another episode of QuanX News. I am your host Prasann Koli, and today we are diving deep into one of the most anticipated IPOs in India. We are talking about HDB Financial Services, which is gearing up to raise an eye-watering 12,500 CR in its upcoming public offering. This could be the biggest IPO in NBFC sector in India. And I know you want to know all the details, so let's break it down. First up, let's talk about HDB Financial Services does. As a NBFC, it's not like your regular bank that takes deposit from the public. Instead of, HDFC focuses on lending, primarily offering loans across three major segments: business loans, asset financing, and consumer financing. It's a pretty wide range. They do everything from giving loans to small business to financing vehicles and personal goods like mobile phones and home appliances. Now, this company isn't a small player in the market either. They have been around for about 17 years and have grown rapidly, with more than 1.68 million customers and presence in over 1,600 locations across India. That's some serious scale, and it gives them a large market footprint, particularly in India's smaller cities and towns. Let's talk numbers. For the fiscal year 2024, HDB Financial Services posted revenue of 8,319 CR, which is solid 10% increase compared to the previous year. Out of this, about 86% of their revenue comes from their lending activities, with the remainder coming from BPO operations and other sources. Not bad, right? But it's the profits that really stands out. 2,246 CR for 2024, making 25% year-on-year growth. Here is something that investor will be watching closely: the interest margin (NIM). This number tells you how much company is making on loans minus the cost of borrowing. HDB NIMs is around 7.85%, which is one of the best in the industry. This is the key indicator of how well they are managing their lending business and their profitability. Then, there is non-performing assets (NPA) ratio. This is a crucial matter, and this tells us how much the HDB loans portfolio and the risk of default. The lower the NPA, the healthier the company's loan book is. HDB's NPA stands at just 0.63%, which is incredibly low compared to the industry average. This indicates strong risk management and makes the company an attractive investment option. Now, you might well be wondering, why the IPO? Well, HDB Financial Services is coming to the market due to regulatory pressures from Reserve Bank of India in 2020. The RBI mandated that NBFC with large lending books should be either reduce their exposure or go public. HDB is taking the public route, and in this process, they are looking to raise around 12,500 CR. However, of this total, 10,000 CR will be come through an offer for sale. This means that existing shareholders, including HDFC Limited, will be selling their part for their stakes in the company to public. If you are wondering about HDFC's involvement, this is where the things gets interesting. The majority of HDB Financial Services is owned by HDFC Limited, one of the most reputable names in the Indian financial sector. This means that when you invest in HDB Financial Services, you are essentially betting on the reputation and track record of the HDFC, which, as we know, is a strong brand with decades of trust built up in the Indian market. To clarify, this IPO is not about company raising the fresh capital for expansion or growth. It is more about existing shareholders, particularly HDFC, reducing their stakes. This is quite common in IPOs and can give investor a chance to own a piece of well-established business with a strong backing. Now, let's take a quick look at the strengths and challenges that HDB Financial Services faces. Now, on the plus side, their association with HDFC Limited is a huge strength. HDFC brings a level of credibility that can't be overstated. Plus, their expansion into smaller towns and rural areas gives them a leg up over competitors who are more concentrated in urban centers. And the major plus is their low NPA ratio, which indicates that HDB is managing risk much better than any of its peers. Their conservative approach to lending, particularly with secured loans, is also a factor that reduces the risk for investors. But of course, no company is without risk. The competition in the NBFC space is fierce, especially as the smaller players start to target the rural markets. Plus, the HDB's dependence on HDFC Limited for branding and business. This could become a risk if the relationship between the two changes or weakens. So, so, how would you view this IPO? Well, if you are an investor who trusts in HDFC brand and is looking for a long-term investment in a growing financial service company, this could be an interesting opportunity. The lower NPA ratio and solid financials and the robust growth prospects make it an attractive option for many. However, as with an IPO, it's crucial to do your own research and assess your risk appetite before making a decision. Now, as we wrap up, let me remind you that IPOs are often oversubscribed, and that could mean you might not get the full allotment of the shares you apply for. But that's the risk and reward of the investing in an IPO. If you manage to get a stake in HDB, you could be looking at some good returns in longer run. That's all for today on QuanX News. Thanks for listening. Stay curious, stay informed, and I will see you in the next episode.